So good evening, and we are back to start with the next session. And I would now request CA registered valuer Mr. Ankit Goyal to start his deliberation, please, as the second speaker of today's Valuation Standards Conclave. We are highly thankful to you, sir, for sparing your time and being with us and providing an opportunity of your thinking, your perspective with regard to valuation standards to this August gathering here. CA registered valuer Mr. Ankit Goyal.
Thank you, Dr. Gupta. Thank you so much. And good evening, everyone. It's a Sunday evening, and I understand that all of you are have to be very, very serious about valuation standards, about IVSC, about IVS to be here on this Sunday evening. And I have no reasons to believe that a valuer should not be serious about these standards. As Padmaji said, as we have heard from all the speakers during the day, that following this IVS, uh, contributing in the development of these IVS, or rather standards, which as we came to know that the government is also thinking of coming out with the customized or Indian standards uh, as suggested to them by the committee. These are the standards that give, I would say, credentials to our valuation reports. Without any standards, without any book to which our standards need to comply with, we will be doing everyone's report will be very different. Every valuer might have different opinions on different matters. We may not be reporting on certain matters on which the valuation standards require us to do that. And I therefore feel, and I'm a strong, I'm a strong supporter, I would say, of following these standards and rather developing further detailed standards for all the valuations that are required in the Indian system. It is very, very important for us to think like that. Today's topic that I've chosen with respect to discussion is a new topic for most of us. It is about ESG. It is about two perspective papers that IVSC has released, one in March 2021, one in May 2021, which talk about how environmental, social, and governance factors affect valuations. We are not new to this idea when we talk about uh, pestle analysis, when you talk about SWOT analysis, when you do all these analysis for various businesses that we are trying to value. We also take care of environmental factors, social factors, governance factors, political factors. But now the idea is that it needs to be extended further, because sustainability with respect to social factors, sustainability with respect to governance, sustainability with respect to environmental factors has become more important now. And we will talk about why that is the case and why we feel, or why everyone feels, that this is more important than other things, or this has grown in importance as compared to how we used to think about this previously. So I prepared a brief presentation. Most of it is content which is available from the IVS perspectives that they have shared, and I have tried to incorporate that into my PPT so that all of us can see that easily. So before I proceed, I need to, of course, reiterate that the international valuation standards are very important for everyone to follow, to comply with Rule 8.1 and 8.2 of registered companies, registered values and valuation rules. It is extremely important that we comply with that for our safety, for the safety of our client, so that the valuation reports are not thrown away by any court. Padmaji very well talked about various case laws where two contrasting case laws rather, where the courts had different opinions with respect to the valuation. So make sure that your valuation report is based on the standard. If it is not, the opposition or the person who is the troublemaker, who is the complainant, may take you for a ride and may make you really regret the decision of not complying with the valuation standards. In cases where you are doing a valuation report and you're basically giving some part of the valuation part to another expert, say maybe a land and building expert, a plant and machinery expert, etc. There also it is very, very important to make sure that that valuer is giving you a report which is compliant with the standards, because you're also responsible for his report if you have got the appointment letter. The effects of not complying with IVS are stark. It is not easy. It can lead to cancellation, suspension of registration, and a host of things that can happen in case the valuation standards are not complied with. And if we talk about IVS, of course, we have talked about this previously also. There are these general standards, then we have specific standards, and I hope that all of you are aware of this new standard on inventory, which has been released as part of the latest IVS, and which is, of course, compulsorily required to be followed with effect from 31st January 2022. And it is optionally available for compliance even today. Coming to ESG and business valuation, now two perspectives papers were released by IVSC on the subject. One was in March 21, as I said, and the other is in May 21, and they have further said that they will continue to discuss this topic in various perspectives paper. And as we heard from the technical director at IVSC also, that IVSC is also looking at future work on the ESG space. So ESG, as we talked about, stands for environmental, social, and governance factors. And we, of course, understand that lately we know so many funds, so many investors, and so many corporations which are now looking at these aspects when they are allocating capital to the various projects that they're working on. And these have become central to the long-term thought process for users of capital as well as providers of capital. Then we talk about how institutional investors are leveraging ESG filters to guide their investment strategies and improve returns. So there is a study which says, study by Morningstar, which IVSC's perspectives paper talks about, which talks about how the majority of sustainable funds have outperformed their traditional peers over multiple time horizons. And it talks about how over the 10-year period ending 2019, 59% of sustainable funds across categories considered bet the traditional counterparts. And additionally, we talk about how if we talk about S&P 500 companies, we say that 9 out of 10 S&P 500 companies are now talking about a sustainability report as part of their reporting systems. And those who are not talking about sustainability, they have to, of course, have to have political investor pressures to report about that. Dharmendra ji, I will request you to mute yourself, please. In case you're not speaking, please mute yourself. Then we talk about, sorry. Sorry. The events of, then we talk about how the events of 2020 have only accelerated the adoption of ESG. Why do we feel that? One, when we look at environmental disasters, we see that environmental disasters have become too prevalent and destructive to ignore. So we see that, when COVID has come in, or when you see that global warming changes are coming in, seeping in into our day-to-day life, we see that, these disasters are too important to ignore. So therefore, a lot of pressure is now on coal usage being reduced, on renewable energy, and so on. Technology transfers for renewable energy from developed economies to developing economies and so on. Then we have social unrest, and how we see that for with respect to social systems, we say that social unrest has obligated enterprises to take a point of view on issues important to the workforce and broader stakeholders. So you might have, the whole migrant workers problem in India, or you could see how that workers problem affected businesses. So that makes people think about how they can create a framework, create a society, create a social structure that can be more accommodating, that can then take care of the needs of the various stakeholders and including the workforce, and how that can affect the business. Then you talk about the governance factors, how the governance structures of every industry and forced management to how it has forced management to continuously pivot as they guide a path to recovery. So it talks about how the governance structures of every industry were challenged, and how the management has constantly involved. So every company I have seen, every industry I have seen, every governing
Well,
structure, government I
Mr.
have talked
Ankit,
about.
Mr.
Yes,
Ankit,
Mr. Garwal.
yeah, actually, these factors, environmental disaster, social unrest, pandemic, all these things, if taken into account and taken into account too seriously by all concerned as far as valuations are concerned, they tend to make it very temporary. I mean to say valid. The validity of the valuation is very substantially reduced if we go by these things very much. So we should devise ways and means that whatever factor affects, how long it will affect or how long it has affected, and then what will be the validity of this particular valuation, so that can be done, so that whenever these factors are considered by the persons who really take care, go through our valuation reports, they should know that yes, these have been factored in and factored in to that extent and to the for that time. Thank you.
So, Mr. Agarwal, thank you for giving us your opinion. So, the idea is that the challenge is not to identify these factors. The challenge is to value these factors, and that is what we are looking at. That is what IVS is also trying to attempt. That how do we measure the impact of these factors on a long-term basis? And if you allow me to talk about my slides going forward, I will tell you how ESG factors are not about short term. ESG factors are about long term in any way possible. And ESG factors in the long run can impact the value of the business with a greater impact as compared to maybe a temporary impact of a lockdown or a shutdown in the business, right? So we are looking at a long term scenario, number one, and we are looking at a scenario where these factors can affect the value of the business, and how these factors are required now to be measured, to be taken care of when we are putting a value on the uh, value on the maybe the shares that we are trying to value. And how do we then use these ESG factors to find out, oh, should we take some factor which will in the long run, which affects this business in the long run. So in case you're doing a valuation, or if you've done a valuation of a coal fired power plant, you would know maybe better than any other person that it is very difficult to say that this power plant will keep running for the next 30 years. Very difficult, because today with the ESG factors coming into being, it is more probable that power plant will be forced to shut down because of other factors, maybe sooner, much sooner, maybe 10 years, maybe 15 years, maybe 20 years, right? But maybe it will not last 40 years the way traditional power plants have lasted in our country or globally. Then you talk about how fewer people today debate the importance of ESG. Why are fewer people debating the importance of ESG? Because most people today are agreeing that yes, ESG factors are very important, and it is something that is globally accepted now. But the struggle is to make sense of the web of interconnected standards, disclosure requirements, and ESG ratings. And the lack of uniformity then results in wildly varying disclosures, and in effect a hesitancy from the valuation profession to wholeheartedly embrace the value creation impact of ESG. So like other market participants, for valuers to successfully incorporate ESG into valuations, they will need a reliable ESG metric reporting that is consistent between companies across geographies and over time. So this is what I was talking about, that you need to talk about standards. You need to find out a way that how will you give a value to these factors being accepted or being complied with an organization as compared to an organization which is not following the whole landscape. When we see globally, we see IFRS Foundation taking a role in ESG analysis and then seeking inputs on the need for a global set of internationally recognized ESG standards and gauging support for its role in developing such standards through the issuance of recent consultation paper. So they have an article, and that article then talks about how ESG and value creation can be linked. Then, if we talk about this article, there we talk about how Mr. Anderson there, who has talked about this article, notes the potential financial implications arising from climate-related and other emerging risks. So what are the examples that he stated in his article? He's talked about asset impairment, including goodwill. He's talked about changes in the useful life of assets. He talked about changes in the fair valuation of assets. He talked about effects on impairment calculations because of the increased cost or because of the reduced demands, and changes in provisions for onerous contracts because of increased cost or reduced demand, changes in the provisions and contingent liabilities arising from fines and penalties, changes in expected credit losses for loans and other financial assets. So look at the kind of financial impact and ESG impact can have in case we look at maybe some industries which are more prone to ESG impact as compared to others. Similarly, if we talk about sustainable businesses, then we can easily say that sustainable businesses will have a way higher lifespan or way higher contribution to the society over time, and therefore those value additions also then can be measured the way we are looking at decrease in value in the in this framework. Then there is also CFA Institute, which has begun work on all these systems. European Financial Reporting Advisory Group has also set up a task force. So everyone globally is working on an ESG landscape. Then whether an ESG framework ultimately sits within the financial reporting framework or separately, market participants are not waiting for a more universal framework when making investment decisions. So investment decisions are happening, and the valuers are playing, given the rules of valuers and efficient capital allocation process is to reflect the considerations made by investors of capital, and it's advisable for valuation profession to do the same. So this is what we are looking at. We are saying that as a valuer, as valuers, all of us sitting at this platform today, we need to give ESG platforms or ESG related factors a weightage when we are looking at valuing various businesses. So then we say that ESG factors, are they non-financial factors or are they non-financial information? So the IVSC in this prospective paper says that no, you should start looking at ESG as a pre-financial information. What do you mean by pre-financial information? So when you talk about pre-financial information, you're talking about how there is a perception by some that because ESG disclosures are typically non-financial in nature, they are therefore do not have a financial impact. So this view, they say, is fails to recognize the ESG represents this view fails to recognize that ESG represents a multitude of factors to assess the long-term financial viability and sustainability of an enterprise. So when you are assessing the lasting value, the analysis must naturally move away from detailed price into quantity consideration and examine the factors that affect the business in the medium and long term. And the ESG framework can for investors of investors. So the ESG has become a framework for investors. So what are the questions that they ask? Does the enterprise have a business model that faces threats from climate changes and regulation? So in case this question comes in and your business or your MD of the business says, oh yes, my business is easily under the threat of climate change, and regulation might affect the operations of my business in the long run, then it becomes a pre-financial information, because then the investor says, oh, you're affected by this, then we are not interested, so sorry, right? So this can happen. Then are its social practices and policies optimized to attract and retain customers and human capital, right? So this is again a question now, and this is again a qualitative question, that are you following business practices that will support you in the long run, will allow customers to work with you in the long run, will allow employees to work with you in the long run, or the moment the employees seek an alternative, they will run away because your practices are not fair. Then finally, is its governance environment such that it can sustain unforeseen challenges that undoubtedly exist beyond near-term line of sight? So this is again something that people ask today. So even if the answers to these questions may not impact the current period financial statements, they can be a leading indicator of financial performance. So in this respect, it is said that ESG should be talked about as a pre-financial information. And given the exceptional rate of technological change, which is exacerbated by the pandemic, in many ways, ESG factors resemble the considerations investors have long made around safe haven assets. So the result is, in many equities now, trading with more consideration towards the store of value qualities rather than near-term cash flows. The idea is you don't look at cash flows alone. You also look at what is going to happen with respect to the ECG factors on the business. Is it going to have a long-term tenure, or do you only see the next year's cash flows and say, okay, I will have these cash flows for the next 10 years. After that, I'll put a terminal value formula and I will compute a value. That's not the idea. The valuer is supposed to look at, yes, will the terminal value be there? Will there be a business after 10 years? Or will the government take it away? Or will the social factors not allow this business to grow? And so on. Then a recent study examining ESG's impact on the fundamentals of equity valuation supports a relationship between ESG and financial performance. So in foundations of ESG investing, how ESG affects equity valuation, risk, and performance, the authors here then conclude that companies' ESG information positively impacted their valuation and performance, and both through systematic risk inputs and their unsystematic risk profile. Dharmendraji, request you to mute yourself, please. So occurring in the tandem to the ESG debate is how to better disclose and report on the value creation through investments in unrecorded intangible assets. So the idea is, if somebody has been investing in ESG related concepts, has been investing in environment and social factors, how do you put that into your financial statements? How do you recognize those intangible assets that might give a return after, in the long run? So that is what is being debated today, that when a company is investing and the company is making an effort to do something for the long run, do something which affects or impacts the business in the long run, impacts the society in the long run, which helps the company keep growing, how do you put that, how do you value that intangible? So value creation through investment in intangible assets is disproportionately focused on long-term prospects. So in that light, consideration of unrecorded intangible assets in ESG framework may represent a more complete framework to uncover the true nature of enterprises' financial sustainability. Then you look at how the decline in interest rates has given to a rise of ESG. And what do you mean by decline in interest rates? Does everyone agree that when the markets are stock exchange or our Nifty exchange, Nifty Sensex, or our Nifty or the Sensex, they increase, and they increase without the earnings getting increased? Can we easily say that yes, that has increased because the expected return on capital or the decline in interest rates has impacted the expected return on the assets, and that is why they have perhaps decreased? What happens when an interest rate decreases? Can I say that when interest rates decrease, the future value that the future value that the future cash flows, maybe the cash flows which were coming to you after 5 years, suddenly increase as compared to the cash flows with a higher interest rate. So when the interest rates decline, what happens is that the value that you're obtaining through a DCF methodology, in that value, the value of future cash flows will increase in contrast. I hope everyone agrees with me on this. So say you have a terminal value coming in, terminal value calculated after 10 years for your business, and then you have 10-year projections with you. And say you put in a DCF, run a DCF based on 18% rate of return, you will get an X value. And in that X value, the weight of the cash flows that are coming in the recent years will be much more as compared to the weight of the cash flows and the terminal value which is coming into the business at a later date. But what happens when the interest rates decline so to say 10% from 18%? In that case, what will happen is that your weight or your percentage weight in the total value of the terminal value and the future cash flows, 10-year, 15-year cash flows will increase. And that is why now we are saying that if a business is not sustainable in the long run, if the business is not going to have a life in the long run, then ESG factors will really decrease that value. Or if you are putting in, or if a business is putting in money, investing into ESG factors and creating value or creating intangible assets off the books of accounts, which might impact the asset or impact the value in the long run, then again one can say that that ESG factor or that ESG part or that amount that you will recover in the future now has increased because of the decline in interest rates. That is what we are looking at here. So the idea, I think you understand the idea, and the ESG provides a structure to identify and quantify potential future liabilities through explicit forecast adjustments or scenario analysis, rather than assuming such tail risks reside implicitly in the terminal assumptions. And the fundamental degradation of near-term profits resulting from pandemic has really shifted. So if you talk about 20 out of 24 industries, they're still projected to still be below their pre-COVID expectations for the near term, that is 22 to 24. And this broad decline in discrete period expected cash flows, much like the decline in interest rates, also acts to shift focus towards long-term prospects of enterprises. And the combination of these phenomena has manifested in equity markets as falling earnings coincided with a much higher valuation of future earnings, as a lower interest rate and bond yields make stocks look more attractive. Then a simplistic example shows the impact of these two changes, how the discrete period represents. So basically this example, if you look at that, what has happened here? What has happened is we have tried to make, the IVSC has tried to compare two charts here. One chart talks about pre-COVID era, the other one talks about a post-COVID era. So see, with a 2% discount rate drop, and even with earnings remaining almost earnings also dropping, the value of the business is actually increased in the second scenario. And what has also happened is, and it has increased from 116 to $131 in case you see this. But what has also happened is that whereas in the first scenario, the discrete period value was 36% out of the total 100% value, in the revised example, wherein we have looked at future cash flows coming in and the present cash flows dropping due to COVID, you have a 23% discrete period value, and the terminal value has increased from 64 to 76.9%. So that is what we're talking about, that if the terminal value percentage in the total values of business is increasing, then the ESG factors are even becoming more important now to be incorporated into the business valuation framework. So then we talk about how the ESG, how the ever increasing adoption of ESG by market participants, as well as the current market conditions, how that how valuers should begin incorporating ESG considerations into the business valuation framework. And the novelty of the ESG framework may cause some to assume a fundamental change to valuation methods and procedures is necessary, and consideration of ESG should be a matter of incorporation rather than assimilation. So while ESG data and disclosures are becoming more standardized for public companies, most companies are private, right? So most companies that we value are private, and on such and if you talk about market approach and you're trying to use a market approach to value a private limited company, the challenge is uh, how do you make adjustments on account of ESG factors, and how will the valuer do that? So the idea, what they have talked about here in the perspectives paper is that a valuer will be required to identify and assess the relevant ESG criteria for the comparable companies and industry, then assess the performance of the subject company for such criteria, and then calibrate the market inputs like EBITDA multiple to subject entity to take into account the relevant performance as compared to the comparable companies. So this is what a valuer is expected to do. Then at first impression, this process appears daunting, but yes, the perspectives paper says that such a process has direct parallels to existing procedures in which a valuer must understand the size, risk, future growth, business comparability, etc. of the comparable companies, then assess the performance and characteristics of the subject company, and then calibrate the market inputs. So these are all things that you already do as part of the diktat or the requirement of IVS IVS 200 whenever you are trying to value a business, or when you are trying to run a market approach as per IVS 105. So you're already using this approach, but the idea is that one has to take care of ESG factors also when one is comparing a market comparable with the company that is your target company for valuation. Coming to the income approach. So while income approach requires similar calibrations to compare the performances and characteristics of the subject entity to that of the comparable companies, a greater reliance on future expectations and the explicit considerations in forecast does add an additional layer of complexity. So what you do, you basically kind of the bifurcation of responsibility over forecast assumptions between management and the valuer is a complex and evolving area. And basically the idea is that you have to make sure that when the valuer is considering the inherent risks, he is taking care of these forecasts and looking at these forecasts from an ESG angle as well. And the ESG framework represents a new set of factors for the valuers to consider and evaluate the management projections given by them. And additionally, management will be best equipped to identify, consider, and quantify many of the considerations noted in the framework. So the basically IVSC also says that, or in this perspectives paper says that ESG framework is not something that is only the responsibility of the valuer, but as the valuer being the valuer has to look at ESG factors when he is looking at how to evaluate the management projections and make sure that as part of that exercise he's also taking care of that. So best practices and frameworks for explicitly incorporating such risk into forecast is already underway, as they say, and the Canadian chapter of CFO Leadership Network has formed a valuation and climate change task force, which talks about developing a framework for climate change and valuation. And then, of course, we talk about systematic and explicit consideration of ESG factors by valuers in its infancy, and how we can structure it, give it more, I would say, structure and more predictability, so that we can use a uniform approach rather than a one-off approach. So an example is that it is common in practice to include a risk premium to the discount rate and to account for the relatively smaller size of the subject company. So it's said in this manner, ESG factor is now also being used now. So ESG factors can now be used by companies to say that, yes, because of the ESG factor, I will like to add a risk premium in the discount rate, so that, yes, I understand that this company may not be investing in ESG factors at all. Similarly, in case a company is investing in ESG factors, I can decrease the discount rate so that I can give that company an adjustment with respect to their future risk. Because if a company is investing in ESG factors and I'm as a valuer, as a management, I'm strongly believing that yes, those investments will pay off in the future, and therefore the investors also see that the risk is lesser in this company, then that can be taken care of. So then, so it talks about how the perspectives paper then talks about how this one example is not enough. One can look at beta, one can look at reliable output from the CAPM, how ESG characters may be added to the current framework for comparable company screening and identification. It talks about long-term growth, how the long-term growth can be changed in a model to reflect ESG factors. Then it talks about alpha and talks about how adjustments for additional risk in the cash flow projections require a detailed consideration, and understanding the ESG profile of the subject in comparison to the comparable public companies can help. The next steps, as given in the perspectives paper, is that ESG solutions require collaboration between stakeholders throughout the capital markets, and currently there is no shortage of opinions when it comes to how and even if to proceed with the standardization of ESG disclosures and reporting. However, regardless of the paths taken by standard setters, including the IVSC, ESG factors represent fundamental considerations to inform valuation analysis. And as such, these first steps to begin incorporating ESG considerations into valuation practices are critical for relevance and therefore the sustainability of the profession. So as valuers, in case the idea is the net sum is that in case as valuers, we don't look into these factors, then maybe we will not be picking up this indication from the industry, from the society, that ESG factors are required to be looked into. And now that investors, investee companies, everyone is looking at ESG factors, it is also time that that valuers look into this. So coming at financial discipline and ESG investments, ESG factors have become a central tenet in many enterprises' corporate strategy. And while companies track and measure how certain investments impact their overall ESG ratings or performance, many often fail to effectively take further steps to estimate and then capture how such investments translate to returns on capital. And when core financial principles arising used to measure ROI struggle to translate the non-financial outputs of ESG investments, and that is the struggle that we are looking at. And so basically then the IVSC talks about how they came out with the first article, and they say that they in the second article, that is the May 2021 article, they're talking about how the ESG characteristics can be incorporated into the value measurement process. And they talk about how they will analyze the impact of ESG on value creation and explore how such a framework may be incorporated into the capital allocation process and bring much needed financial discipline to the ESG investments. And then they talk about that they will like to discuss why earning based measures for ESG investments can be difficult to apply. Then they talk about how they will examine the close link between ESG investments and intangible asset value creation and maintenance, and the resulting implication that ESG returns can be better assessed by reference to intangible asset value creation. Then we talk about leverage such insights to develop an example framework to assess and measure ESG value creation opportunities at the enterprise value. And they discuss a framework that refers to both direct and indirect intangible asset creation, including recognition that intangible value creation via ESG investments can be scalable due to the interconnection between assets. Then they talk about measuring ESG returns, and they talk about expense versus investment. So in case today I choose to invest into maybe developing a housing colony for my labor, which is working in my plant, is that an expense or is that an investment? Some people can say it's an expense. Somebody can say it's an investment. Somebody can say there was no requirement. They were already living in a juggi very close to the factory. Why did you make a housing society for them? Why did you incur so much money for them? Or why did you make a school for their children? Right. So these are all social factors that you invest in and you find results. So it's not new to us. We can see that many companies in India, you look at Birlas, you look at Tatas, You look at other companies, they have been investing in the social welfare of their employees, and that has given them a good reputation always, more stability for their employees, and so on. Similarly, when you look at environmental factors, there are many ways for organizations to cut corners. Today, in case you look at social media, you will see that a lot of organizations are actively looking at cutting down plastic as part of their, or cutting down packaging as part of their overall business process. And why is that happening? That is happening because of the idea that now people want, or people are asking for a more socially or more environmentally safe process that a business can adopt. So the next time perhaps you go to that नारियल वाला and say अच्छा एक नारियल एक पे नारियल देना पानी नारियल पानी पीने के लिए मुझे पानी दे दे तो and he gives you a straw, a plastic straw. And if maybe you, or maybe similar people having the same mentality, ask him that, no, I need a paper straw, or don't you have a paper straw, maybe that person will start looking at, or start feeling at one point in time that, no, I don't want a plastic straw, I would rather have a I would rather give people a paper straw so that they feel better and come back to me again. So it is all about social feedback. Society gives a feedback to businesses, and business implement that. So today, in case you look at all these mithais and all these packagings, I sometimes really feel that yes, a lot of plastic can be cut down by them without maybe even incurring too much of an expense. But then yes, at the boardroom level, that has to go, that has to be discussed. So when you talk about expense versus investment, when a company say invests into maybe paper or an alternative recycled kind of an packaging and leaves a plastic packaging, is that additional expense that they're making, where they're also reducing their profit? Is it an expense or is it an investment? Somebody can say that it is an investment. Somebody can say no, it is an expense. Totally depends on how you see the perspective as a society. Then expenses typically include provide an identifiable and quantifiable link between the cost incurred and the benefit received. And for investments, on the other hand, the connection between cost incurred and the measurement of benefits received is often more ambiguous. So the idea is that an example is that in the end of accounting and the path forward for investors and managers. So basically, he talks about explanatory power of reported earnings and book value of market value between 1950s and so he did a analysis, and he said that basically the more recent evidence, they say, suggests that the global pandemic has accelerated this trend that you look at explanatory power of reported earnings and book value of market value. So you now see that book value is something different, and the expected returns are something different. They are breaking away the relationship because maybe we're looking at too much weight on the future earnings. So like other investments, connection between ESG cost incurred and the measurement of benefits received can be difficult to identify, track, and measure. And while significant progress has been made to incorporate discrete climate-related risks into valuation and forecasting processes, many ESG investments share unique characteristics that challenge the ROI analysis. So uh, as we were also hearing uh, 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 from Padmaji, that she was taking this example of a metro, and she was talking about how the metro helps the society apart from helping the commuters who are using it. So, who is benefited by metro? I would say so many people are benefited by metro. When a metro investment happens, yes, you build new infrastructure, you give employment to all the people who are doing work on that new project. You then help the commuters save time, save energy when they're traveling in a safe, air-conditioned environment which is free of jerks, free of traffic from roads and from vehicles, and then you're decongesting the vehicles. Then you are removing all these emissions from the environment, because when you are removing people from their cars and putting them into metros, in the metro, then you're also using electricity which can be used which can be generated from renewable sources. Then you look at what else when you look at a metro, I would say that You look at ease of reach for many societies, many colonies which would otherwise not be able to allow their residents to come and work at a particular location. With the metro coming in, the social factors are that that person will be easily be able to work at a distant environment, even if the traveling time is 1 hour, because metro maybe is offering a safe environment for them to travel, for all those people to travel, right? Then you look at governance, again, with respect to governance, metro is helping the governance factor in the sense that people are happier, people are more content, and people are, I would say, more supportive of such large projects, which can help the community in a very, very impactful way. So when you talk about such characteristics that challenge the ROI analysis, you first talk about ESG benefits, which often accrue to the enterprise as a whole and even outside the enterprises. So that's what Ma'am was also talking about. Uh, that's what Padmaji was also talking about. And you look at additionally for those benefits that accrue outside the enterprise, and a warranted data debate exists regarding if and how such benefits should be included in the return considerations. So the debate is separate from that of a principal agent, but rather to how positive externalities may create a benefit for the enterprise, right? So in case an enterprise like a Delhi Metro Rail Corporation has invested, built up the trains, how do they evaluate and put into their balance sheet some value that is being created because maybe Delhi is not as polluted as it would have been had the metro rail network not existed? So how do they benefit? How do they say that yes, maybe some people will not be falling sick because of the environment being better? Maybe some people would now come to work, whereas they would not have come to work earlier. Is there an effective decrease in the wages of DMRC itself because it has been able to maybe have some employment from people who would not have worked had the metro not existed, right? So all these are very complicated numbers that we are talking about. That's why they're difficult to measure. Then ESG investments are often made over a number of years and the benefits are often long term. So such investments may even result in sorry, ongoing value creation into perpetuity. Then ESG benefits are often risk reducing and may only maintain existing cash flows rather than generate incremental discrete cash flows. And risk reduction of ESG investments is often reflected in an enterprise's ability to recover from an adverse shock or adjust to changing dynamics. An enterprise's ESG strategy and implementation may even determine the viability of the enterprise itself. Then, given that ESG investments often generate non-financial information, a strategic financial framework should consider not only the impact of the return matrix, but also value created. So such a framework should outline the value proposition of ESG investments, assess whether such investments have created value, and if possible, connect any value creation to the resulting financial information. So focus on value creation can help improve the critical linkage between the investments in ESG and return. Then looking at the link between ESG and intangible assets. So the paper has said that in their view, the potential ESG value creation would manifest in the formation and or maintenance of intangible asset value. So certain characteristics of intangible value creation can help us assess how ESG investments may create value. So first they say that value creation or degradation for intangible assets, and therefore ESG investments is not linear. So for instance, it says that many ESG investments will likely show a small return in the initial years after investment as value is created, and then exponential growth out thereafter. So additionally, if not maintained, the value will also likely decline in a rapid fashion. And if ESG investment continues to support and enhance the value created, the asset value and resulting benefit may be maintained indefinitely. Secondly, it says that the ability to create intangible value and thus the ESG value creation opportunities varies by industry. So to generate economic value from ESG investments or any investment, an enterprise must generate returns above those required by value of tangible assets and financial capital employed. So ESG value creation, it says, is ESG value creation opportunities should be higher for companies with a differentiated, value added, and high margin business model than for companies with a commoditized, tangible asset intensive, low margin business model. And finally, it says that the business model industry often also dictate which intangible assets will be created and which will offer the highest return. So similarly, it says that the same is true for ESG, but which of E, S, and G investments will generate which intangible assets? So answering this question, it says is necessary for enterprises to articulate the value proposition of ESG investments. So then it tries to answer this question, and it says that the article says that we postulate how E, S, and G investments may generate value, enhance cash flows, and maintain value for specific groups of intangible assets, including brands, human capital, customer franchises, and technology. We examine the potential value creation life cycle in the figure below through three separate strategies. What does it do? It says direct assets. So these intangible assets which may be directly impacted by the E, S, and G investment. And then talks about indirect assets, those assets which could benefit from value accretion of direct intangible assets which has targeted with the E, S, and G. And then scalable value creation, where you say that the final phase of life cycle recognizes that intangible asset value creation via ESG investments can achieve a scalable return as a result of interconnection with other intangible assets. So I will now share the report that is here. I will just give me a second. I will put that graph in front of you. So in case you see my screen now, you look at the ESG investment. So example is that environmental investments like carbon emissions, deforestation, resource efficiency, waste management, water scarcity. What is the direct asset creation? Direct asset creation can be strong environmental practices, elevate the brand, allowing enterprise to charge higher prices. And then financial output can be enhanced brand, both relative to competitors and on absolute terms, thereby increasing profits, reduce risk of brand damaging environmental event, right? Then indirect asset creation can be an environmentally strong brand helps to attract and retain talent. So human capital can be retained by you. Then environmental conscious brand helps retain and grow customers franchises. So that can be customer franchises. Then what are the scalable value creation here? Scalable value creation is that when you have human capital, it is linked with the overall corporate brand. Then that creates a brand, right? Then the brand as an intangible asset that you have grows because of your efforts or because of your spending on environmental matters. Similarly, when you're having human capital driving technological innovation, you're increasing your technological intangibles. Then when you have human capital helping to retain and grow customer franchisees, or when you have customer franchise increasing because of your environmental conscious brand, then customer franchise can also increase as a brand. Similarly, when you talk about social factors, so when you social factors, the direct factors that the direct asset creation is human capital. So strong social practices have a positive impact on the human capital formation and maintenance. Then attracting and retaining top talent drives innovation and profits. So then that leads to technology, customer brand, customer franchise, brand, and then that creates an indirect asset and stuff. And this is how the writers of this paper, perspectives paper, talk about how value can be created in the form of intangible assets when a company invests or when an enterprise invests in the ESG factors. So environmental, social, then what are the social things you can do? You can do development of human capital, you can have employee engagement, gender and diversity, health and safety. So all these help in this manner. Then looking at governance, you can talk about data protection and privacy, board diversity and structure, corporate governance, executive remuneration, transparency, whistleblower policies. So these are all governance related matters which affect your brand, which affect your customer franchise, which affect your technology, which affect your capital, human capital, and then that in turn grows your brand, customer, and then it's a vicious cycle that it keeps growing as long as it can. Any questions on this chart? And if not, then I can come back to the presentation. Then the link between ESG and intangible assets, certain then you talk about how we look at patterns of potential value creation, begin to emerge some analysis above. And then while G largely reduces risk and maintains asset value, social investments tend to drive asset creation and cash flow generation. Environmental investments tend to fall in between, and with an expectation that the relative mix of risk reduction and asset creation will be highly dependent on the industry and related exposures to environmental risks. Then with a better understanding of how ESG investments result in value creation via specific intangibles, and given that intangible assets value drivers are well documented and understood, we can identify certain characteristics to help assess expected relative value creation of ESG investments. So the idea is, in case you know that, okay, if I put money into environmental factors, this is the intangible asset that might grow. Now it is easier for you to give a value to those intangible assets or those earnings or those effects which those ESG investments might produce. So they have talked about 6 characteristics which have been identified along with brief descriptions. And one is reliance on brand strength. So it talks about enhancement and maintenance of one's brand, and then brand power can generate excess returns between identical products with no more than a name and reputation. So this is what it does. Then it talks about reliance on human capital and workforce skill level. Then it talks about premium to book value and value added business models. It talks about nature of customer relationships, tangible asset intensity, market dominant technology. So these are some examples. And then they talk about how they have given a graph in the study which talks about how 5 enterprises from different industries can scale from 1 to 5 with respect to various such investments. So they say that in case you look at a professional services entity, you can look at the brand strength there. You can look at lack of proprietary technology affects them, so therefore the value there goes down. Then you have a contract manufacturer. There you have minimal numbers on all accounts. Then you have a branded customer product. So a branded consumer product will have a uh, how the branded customer products will have a high brand strength because of ESG value creation. They might have a high lack of proprietary technology. They might have customer relationships. So the level of impact on a company with respect to ESG value creation can vary based on your industry. So because you are a branded customer products business, you are highly reliant on your brand and your customer relationship. So therefore, those will be the most impacted ideas behind you making ESG investments. But in case you talk about a biotechnology firm, it will be more with respect to reliance on human capital, premium to book value, intangible asset intensity. So those will be higher contributions. But in case you look at a business like a distributor or a contract manufacturer, there, because most of these intangibles will maybe not create too much of a value for you, they will therefore can have a lesser impact. So in case of a traditional business, we frequently see in India that somebody who is having even a small business, maybe a shop, and maybe somebody who comes out to be a person who is a good human being, who is taking care of his employees, there the employee retention will be higher, right? All of us understand that. So those are the social factors we're talking about. Similarly, in case we look at a person who is taking care of his environment, who's taking care of governance, who is making sure that he's on the good side of his law, we know that that person can have a longer business, or longevity of the business can increase, despite that person not really relying on a brand and maybe even only a location, a fixed location that he's working out of, right? Then a framework to assess ESG value creation opportunities at um at just a, just a minute. So framework to assess ESG value creation level opportunities at the enterprise value. So there is an interactive graph analysis. So we have talked about how that interactive graph analyzes these 6 criteria from 5 enterprises, and how that affects the business. The next steps in summary to this perspective study is that a focus on intangible value creation can bring more financial discipline to ESG investments and bolster sustainability reports to go beyond lists of statistics and overtly qualitative narratives. And longer term, a focus on intangible value creation can facilitate a move towards a financial reporting system that captures intangible value creation. So while the current accounting framework often lacks relevant information on value creation, there are examples in which it is also actively constraining efforts to fully implement value creating ESG priorities. And then it talks about a recent article examining how current accounting practices is constraining the net zero transition. The authors analyze an oil company's commitment to become a carbon neutral by 2050 in the context of ESG and the current accounting model for intangible assets and liabilities. And they argue that the current accounting model unduly penalizes and demotivates companies as they attempt to make such investments. So this need is no more succinctly articulated than in the author's analysis of both technology and brand intangibles, and the latter of which is discussed below. So it says that a further clue is provided by the IASB conceptual framework, which defines an asset as a resource controlled by the entity from which there is a potential for future economic benefits. So we postulate that while an organization does not control the environment, its employees or other stakeholders, it has control of its relationship with those entities, intertwined with its reputation through alignment of its decisions with social norms. So it follows that the definition of an asset should be applied to an entity's reputation or its social license to operate, resulting in capitalization and fair value of these assets. And it's basically, it says that this IASB conceptual framework itself says that the asset has to be as defined as a resource which is controlled by the entity. Now, do you control the environment? No, maybe the business does not control the environment, but the environment is affecting the business in multiple ways. And then it talks all then ends up about the discussion is about you're in a box, and all the things that are outside the box also impact you. You as a box can also impact the outside items. So how far can you go and try to pick out those things which are outside the box and give a value of those assets or those efforts to make those lives outside that box better as part of your own balance sheet, as part of your own value structure? That is what is the concern that they've talked about. Then such constraints within the current accounting model are not limited to brand and technology, but also exist for human capital. We all know that in 2 Sigma Impact, finding untapped value in the workforce, the authors note how current accounting drives behavior that limits the value creation opportunities for human capital. And then they state that private equity has tended to view labor as a line item to be reduced rather than a place to invest, so resulting in large blind spot for the industry. So assembled workforce, as we all know, is something that is rather difficult to value as an it is not even possible to value as an intangible. However, yes, that is a significant intangible that I believe belongs to any business, especially those businesses which are into services industry. Assembled workforce is a big chunk of how those businesses can derive any value. Such insights are not meant to argue that ESG is a fad that will soon go out of style. So, to the contrary, ESG is inextricably linked to an ongoing effort by accounting standard setters and investors to further explore opportunities to systematically address internally generated intangible assets. So internally generated intangible assets, as was also discussed by the technical director at IVSC is something that is gaining momentum. That yes, why not value your intangibles if you're valuing your land at your fair price and not your historical price? So then it talks about how in the IVSC article says that our next article series, they plan to further explore opportunities for considering intangible value creation by reviewing the goals and opportunities for an enhanced framework, performing an analysis to map the types of costs that give rise to intangible assets in order to identify intangible assets, and then exploring whether an enhanced framework should be based on enhanced disclosures, capitalization, or value creation concepts. So with that, I end my presentation. If anyone has any questions, you're requested to please share those with me. I will be happy to answer those.
Thank you so much, CA Registered Valuer, Mr. Ankit Goel, for a very, very broad and illustrative deliberation on this very new concept of ESG and valuation. Even though we really don't have any standards as to how to actually carry out valuation of ESG factors, but as IVSC has released these two perspective papers, we thought it would be very useful for all the participants to at least have a basic understanding, and then you can perhaps read those two papers yourself and also Google out and find out some more material so as to be kind of future ready, because this is going to become a very critical aspect of the valuation going forward. And it's time now for all of us to prepare ourselves for the next generation of valuation methods and approaches where ESG will play a very, very important role. So thank you so much, CA Registered Valuer, Mr. Ankit Goel, and also Madam Padma Ganesh, Registered Valuer, for giving us a very, very different novel perspective on various dimensions of valuation standards. The house and the floor is now open for any questions that you might have from the two speakers of the evening, please. Anyone can raise a question. Raise your hand, please, and ask the question.
I would just like to clarify that time I think Mr. Rajiv Chopra had asked one question regarding that one judicial pronouncement which I had
Yes,
quoted.
please. Yes, please.
Yeah. So he was asking like how this resolution would have happened. So he can go to IBBI website and check in that corporate processes. The company name is Solidaire India Limited. The resolution happened at 12.56 crores. In that order itself, it is discussed that the land value was 31,710 rupees, treating the fees paid towards assignment as the value of the land. So you may go through that order, sir.
Thank you. Thank you.
Thank you.
And now I have got another question, but
Yes.
this is to Mr. Goel, and
Yes,
I
Rajiv
will
ji.
request MDs are also to be part of
Yes,
it
sir.
while
Yes,
answering this.
Yes,
That when we talk of this ESG, how far is this relevant for this CIRP companies? I mean, cases under liquid with this IBC, particularly when it discusses or gives an insight about the cases which are in the form of a going concern making healthy profits, and when it is a case of acquisition, merger, or merger M&A or something like that. On one side, those kind of cases, and on the other side, as most of the participants in this group are from with IBC background, and as the other member of the group was discussing that if we factor that part while calculating the valuation, the valuation goes down further, be it in case of CIRP, or be it in case of resolution, or be it in case of liquidation. So once you give the multiplier effect of this at the time of valuation, the value goes down, and at that price, when it is taken by the resolution applicant, there is far hue and cry in the market that the things have gone down at such a lower valuation, as is the case of, say, Videocon or many others. Now, my point is that on one side, we are talking of giving the effect of ESG in IBC cases, which should have been in general ongoing profit-making companies cases. And on the other side, even the bankers, on one side, selling the things at 6% or 8%, and on the other side, bankers transferring those same kind of power plants, as Mr. Ankit was referring to the bad bank at minimum of 15% with the reserve price, which they are getting from the bad bank. And in it, over and above that, there is an SR for 85%. So how far would that be justified to link ESG to IBC cases? This is my question to both of you. Rather, I would request Padma ma'am also to join them.
So Rajivji, I will try and answer your question, and I think it has multiple questions within the same question.
I know.
And
And it's a very relevant and practical question.
let me try and
You see,
answer the let me
assets
try
are
and
being sold at throwaway prices, and we are giving impact of this. Based on that, we are valuing them down further, and based on that, they are being sold. After being sold, there is hue and cry, and even bankers are reluctant to come out in open, and then they are more than happy to sell those power plants to the bad bank, where even if they get liquidated, they get minimum 15% plus over and above that in the form of SR.
Okay, Rajivji, so let me try and answer this. So when we talk about, say, let's talk about a power plant. Maybe, 15 years back, somebody conceived that, yes, maybe the government conceived, others conceived that, no, we should build more power plants because that is the need of the country, that, yes, we will need more power plants because of a growing economy. We will want more power to be produced in the country. But today we have a different scenario where, yes, the power is excessive, the rates have dropped, and yes, for a person, for various power generation companies, there is no market for that power. Moreover, there is a technological change. Now, larger, bigger power plants having huge capacities are producing power at a fraction of the cost as compared to maybe a 300 megawatt power plant or a 500 megawatt power plant. And then the technology has changed. Now there is supercritical, and then there is technologies that allow for power production cost to drop like anything, even in case I talk about a coal-fired power plant. So we're looking at a technological change in this industry, because of which certain power plants have no future because they may not be able to compete with that better technology that is also available in the industry. Now, the critical element is, and the idea is to recognize that which of the power plants will survive, which of the power plants do not have a future, which of the power plants will never see the light of the day or never see a going concern mandate or a going concern future in the near future. So what do we do in IBC? When we do a valuation in IBC, we at AAA, we first see that is there a going concern value for this business? A plant came to us which was manufacturing crowns and closures for these Pepsi bottles. And we said, okay, let us analyze whether this business, we did an industry analysis. We saw that can there be a buyer for this item, for this industry in India? Will somebody like to take over this industry and run this plant as it is and keep manufacturing these crowns and closures for, the various consumers in the industry? And we found out that no, crowns and closures are no longer items that are in fashion, and rather, because of other than the steel closures, the industry has moved to the plastic caps, and therefore that requires a different technology which is perhaps not even available with this company. So why will somebody invest in this company to buy an old technology? So you need to understand that certain businesses go out of fashion. Certain businesses lose the flavor of lose the choice of the customer. Certain businesses lose their economic or are economically obsolete because of their cost disadvantage over the new technologies that are available. So we need to look at all this through this light. And we also need to look at that when we look at IBC, we should understand and give this benefit to IBC, that IBC is aiming to capture that ill patient at the right time so that it can be revived. But if that patient takes too much time in coming to IBC, and by the time he comes to IBC, maybe he started with low level sugar, but by the time he came to IBC, he's now having an eye problem, he's now having a kidney problem, he's now having various other organs malfunctioning. What can IBC do with a magic wand that can suddenly transform that patient into a healthy person? Had that person came in earlier, maybe there would have been a better rescue.
That was
So-
not my point. My point
I
was
am-
related to ESG, factoring
And
of ESG in the valuation of IBC cases.
So I'm coming to ESG now. So when we talk about a going concern business, we are always taking into factor the going concern value of the business, and we all understand that going concern value of the business also includes the value of the intangible assets of that business, along with the tangible assets. So intangible assets, tangible assets, they're all valued when I'm trying to project that what will this business make in future. When I compare it with the market comparable of a business which is already a going concern, I'm already taking into values where that other businesses intangibles are being recognized by the industry. So when I talk about ESG investments, which might have been made by a business in the past, now looking at, say, maybe a case like Videocon itself. Now, Videocon might have had a lot of good relationship with their employees in the past, and maybe somebody who wants to buy that company today will acknowledge that and say that because of the old relationship, I will enjoy a better relationship with my manpower. I will perhaps therefore spend lesser time or lesser effort on giving stability to my workforce, and therefore I might have a better future. Maybe a company which is under insolvency, which is a going concern, has a very good, very healthy, and a very robust housing colony for its employees. Will I not give the factor for that housing colony with that which is available with the company as part of my DCF approach or my income approach? I will surely say that because of that housing colony, maybe this company will be able to pay less, 5%, 10% lesser salary as compared to market, and still retain its employees. So these are the financial factors on the brand, on the customer, on the vendors, on the human capital that I will need to incorporate in my DCF approach as part of the ESG factors. But as I said, Rajivji, it will totally depend on the state at which the customer has or the patient has come to IBC. If the patient has come in very bad condition, I may not have a option as a valuer, but to value only its intangible assets and assume that all its intangible assets are already don't have any more value.
What I was trying to say is that anyone who comes to IBC is either in ICU or in CCU. So to those kind of patients, if you are giving this kind of injection, which evaluates it further down, and then it is bought by the people, which creates hue and cry in the market once it is done, and that can be justified with the fact that the same asset is being sold by the same bank without doing any efforts to the bad bank at twice the price. So
So Rajivji,
what is the relevance left for discounting or giving the
so
impact of ECG
so
factor in the
Rajivji,
valuation of
so
IBC cases?
So Rajivji, there are many companies which have been running when they have come into, which are a going concern when they came into IBC. They were a running condition they were in running condition during IBC. Rather, in many companies, you will see if you research on this and if you look at those companies which came into IBC at the right time, you will see that they were earning better profits as compared to before IBC time because they were free of the requirements to service their debt, to service the creditors, and they did a better performance, and then those companies today are further being expanded by the resolution applicants who have taken over these companies.
My
So I
question
think
was
your
slightly different. My question was to the limited point whether the ESG impact should be given in the valuation of IBC companies which are already down, which are already facing those kind of stress and still not able to pay, and then valuing them further. On one side we talk of valuing creating the value of the business, and on the other side we are valuing them down by giving the impact of this kind of ESG factor, which might be totally irrelevant, keeping in view the fact that this is not a profit making concern, it's a loss making, not able to pay the debtors. That was my limited point.
So I think
Anyhow,
I have
no
shared
problem.
my
And
view,
yes,
and I
no
will
problem. Please,
allow
please,
maybe
please.
Dr. Gupta and Padmaji to share their views on your
I know
question.
there are a number of companies of which we are aware, which probably have a balance sheet size of 100 crores and maybe having a market cap of 500. Because even the research says that the financial statements of the company reflect only about 25 to 30% of the value of the company. The rest of the value of the company is generated by the intangibles, whether you call them ESG or by any other name for that matter. So while evaluating a company under IBC, even then we should, I mean, it's going to be become mandated very soon going forward. I mean, very soon this all going to get mandated. But even at this point of time, we should definitely look at the intangibles and the ESGs, whether it gives the value a downward trend or an upward trend. That depends upon a particular company. A company might be in a financial distress, but could still have a lot of value in terms of ESG factors. Why not? I mean, there could be companies which are financially distressed. That is where we have a new reporting, corporate reporting emerging by the name of integrated reporting. Right now in the financial statements, we are only concerned with financial capital, but integrated reporting report looks at 6 different types of capital: financial capital, human capital, social capital, relational capital, natural capital, environmental capital, manufactured capital. I mean, going forward, we need to build these factors into valuation, irrespective of the fact whether it's going to further give a downward trend to the value of the company or upward. That's besides the point. But I think going forward, this is something we need to be doing, all of us. That's the way forward. That's the way I look at it. Padmaji, you have some views on this? Padmaji, would you like to?
I was on mute. Yeah, as Dr. Gupta says, it doesn't matter whether the value is going to be taken upward or downward, but you have to factor in. And just for to this extent, like I had given one CEP session on this ESG, in which I had prepared one slide which would show you exactly how the cash flows would be affected when you take into account these ESG factors. So let me see if it can help you understand in some extent. It need not necessarily pull the value downward. It can also show some upward trend on this. Like see how this ESG factors could be translated to cash flow adjustments. Like see, you can see over here, if the operational revenue stood at 2000, I'm just assuming here for this purpose, I had assumed that it is a proper business. I mean, it's a going concern. It's not into CIRP or anything, but for a normal functioning business. So if the operational revenues were at say 2000, now due to the bad reputation on account of bad working conditions of the worker, which comes under the social factors, there is a decrease in the operational revenue by say 300. So this kind of a decrease can also happen when you attribute it to such factors under this ESG. Now, likewise, this additional tax payments due to fines imposed by the regulatory authorities. So this is because of some non-compliance with the governance factor that the company is forced to bear this additional tax. So on account of two heads, say on account of social factor and governance factor, this particular business has borne some additional expenses. And now here, if you will see the environmental factor for carbon pricing, they have to build in something into their capex. So the additional capex that they have to bear is some 100, which we have factored. So considering all these factors, which has entailed some expense, the ESG cash flow was worked out. But at times, it can also happen that your sales can also increase because you may have a good reputation. Like you are being very fair to your employees or any of those factors with which Ankit ji had listed, and I think I too would have it in my PPT also. So any of those factors, if it gives a positive impact, that is going to add to your cash flows, and where it is something negative, you will be reducing. So it need not necessarily be that it is often on the decline that it will be showing. Yeah, any of these factors, say deforestation, water waste management. So if you are being compliant with it, it will add to your cash flow. Where it is not so, there it is going to add to your expenses. So it like it's not like what you said that it's going to pull down the value.
No, I never said it will pull down the value. I presumed it that in case of IBC cases, because of the stress and giving the multiplier effect of this ESG non-compliant, making them ESG compliant will put their value further down. And compared to that, when it is bought by the new buyer, there is hue and cry in the market. And you are of the view that even if the valuation goes down, it doesn't matter. The people buy it at a lesser price, it doesn't matter. Bankers get less, it doesn't matter. This is what you hold. What I am trying to say is slightly different from that in the sense that bankers are happy selling them through this rather than selling them through this route to the straight bad bank route at minimum 15% compared to the 6%. That was my query, and I was unable to understand this point, and that is why needed this clarification. Anyhow, you have explained your viewpoint.
I don't know how far your doubt is clarified, but this is a factual position.
I mean, you have explained your views. I got it the way I wanted to get it, and thank you very much for that. Nothing wrong in that. One can have different views on different points.
No, it's a new emerging area, sir. All of us are trying to understand how to factor ESG factor. There's a very, very new emerging area. All of us are learning. I mean, how to.
No, I fully agree. That is why I said in the beginning itself that
sir.
those which are big corporations, like you can say in case of Apple, Google, Facebook, this is 100% relevant. But for IBC kind of cases where it has the impact of reducing the value further down, that becomes all the more critical.
Absolutely.
This is what was my limited point.
Sure, sir.
Thank you.
Any more questions, please?
Second was this to Mr. Ankit Goyal once again, when he was saying that this investment in this housing colonies for workers and all that, whether it can come under as an expense or what. So to that point, I just wanted to ask him that unless and until our accounting standards permit that to book them as a expense, how can we book it? That was my simple query to him.
So that's what the paper or the perspective also talks about, that the accounting standards rather push a company to report numbers which are financially correct, to show some profits, etc., etc. And the accounting system does not permit those companies to talk about, or financially, when you talk about the performance of the company, and you look at the financial performance of the company, it does not allow the company to talk about, or does not give an adequate window for the company to talk about how its operations or how its ESG efforts has impacted the society outside its financial statements. So that is what the idea was.
Need to be built up first.
So the idea is that yes, when we look at financials, when we look at financial statements as investors, as shareholders, the idea is that we only look at a profit. We only look at a PE number or a EBITDA multiple when we look at a company as a valuer. But if we look at a company from a valuer's perspective and say that yes, this company is a regular investor in ESG factors, and therefore its valuation will be higher because more investors are willing to own the stock of this company even if they earn a little lesser than what they would have earned had they invested in a company other than this company. So the idea is that yes, today maybe with the Zerodha in everyone's mobile phones and everyone trading on their phones, there will be some preference for those stocks which are also creating good value for the society in some way or the other, and not only on the basis of their profits.
Undeniably, this kind of efforts always create good value. But yes, I was simply, being an insolvency professional, was trying to link it in that context only. And there I found the mismatch in the sense that when one is not able to make the payment, how can he show these kind of things as an expense? And secondly, the accounting standards also do not permit it to be booked as an expense. That was the simple point.
Rajivji, somebody who is a resolution applicant who is trying to revive the company, I think as a resolution professional or as an insolvency professional, you're helping that person take over that company, run it successfully, and handing over that company in a way that he's able to create value for the society. And I think that is one of the ESG contributions that maybe insolvency professionals should also note for everyone.
Pre-resolution and post-resolution is post-resolution fully understandable. Pre-resolution, slight apprehension. That's it. Thank you.
Thank you.
Any other questions?
Gupta Sahab, I have got one question for Mr. Goyal.
Go ahead, sir.
Mr. Goyal, let me tell you first, sir, that this was the first time that I came to know ESG valuation. Nicely you have covered. Thanks a lot for your illuminating session.
Thank you, sir. Thank you. It was a learning experience for me as well.
So
Yes.
nice, so nice. Acha, my precise question is, of course, the concept of ESG is still picking up or still at the nascent stage, whereas CSR and sustainability has already taken deep dives in Indian corporates. So for last 10 years, this CSR and sustainability. So both these things also equally demand the valuation and the valuation standards. So I just want to ask this question, whether this ESG concepts and those valuation standards, what you have spoken, can they be applied for valuation of CSR and sustainability efforts of the company?
So the idea, I believe, when a company makes a CSR effort, say maybe Reliance today is making an effort to build a organ donation network in India. And now this kind of an effort is something which I can easily classify as a social effort, which helps the health of the general public in India. And it may not be impacting, maybe a particular area or a society, but maybe the entire country. So it's a big project. Now, in case I pick up this kind of a project, and I believe that in case anyone who either gets a direct welfare from this kind of a scheme, or somebody who believes that this kind of an initiative should be should help the society in general, might want to own this stock only for the purpose of this, or helping this kind of initiative, that they're doing the CSR initiative and they're serious about it. Versus maybe I tell you about a company which is just doing CSR for the namesake. They put in a para of CSR in their balance sheet, and then you don't find any credible project that is being taken up by that corporate. So I believe that in case you're an investor, you would definitely think about this factor as part of the ESG factors that will affect your decision as an investor to invest in either of those companies. And yes, CSR disclosures, as the article also, or as the paper also talks about, that ESG disclosures are different in different countries. And we can easily say that CSR disclosure in balance sheets, that is a mandatory requirement in our country, is a way of ESG disclosures in our country.
So there are ESG specific mutual funds which are very common and popular outside. Even in India, 4 or 5 mutual funds have been launched. The latest one being one by Aditya Birla Group, which focuses on ESG. I mean, they look at the ESG factors, the ESG ranking of the company before putting those money into those kind of companies. We have specific funds. Even 4 or 5 funds are currently operating in India as well.
So nice.
Very right. Very right, you are.
Yes.
Very right, you are. That is where people invest.
I know. So impact investing is a new concept which is emerging, that whatever investment investors are making, they're looking for impact on society, impact on environment, and they're willing to take a kind of a lower return, even if that be. But they want to contribute towards environmental protection and societal development, and they're wanting to invest only in those avenues which care for ESG.
Excellent.
Exactly.
So
ongoing,
nice.
contributing to all this, and profit making also.
Yes,
That
sir.
is why people are investing there in their mutual funds.
Yes.
Arun, may I ask
Thank
a small doubt?
Sure, sir. Sure.
Sir, I had read one news in the some of the WhatsApp group. One of the persons has informed on short note. One startup company was started with around 3,000 crores investment by the foreign company, and the company was incurring 2 losses, and the net value was around 4,000 crores. And the executives and the CEO, everybody was highly paid. And now, because of the market, share market is improving, they had gone for IPO. Before IPO, they had taken the valuation of the company. The valuation was estimated at more than 60,000 crores. So they were able to fix premium rate for their share, and the promoters has offloaded their shares, and they were gained around 5,000 crores. Is it a fair treatment on the part of the valuer? That was a question he has exactly asked.
So I
The
believe
newcomer
this.
startup company.
Yeah, so I believe this question is not related to ESG.
I don't know, sir.
And I believe that this question is more related with the valuation of a company which perhaps is still not generating any positive cash flows, but which is valued by maybe the valuer, maybe by the investors as at a high valuation. The only answer to that, sir, is that maybe there are a lot of investors, and maybe that valuer also believes in the value of the company, in the future value which might come into the company at a future at some point in time. And those of us who are not appreciating that can leave that stock aside and let it be, and those who are willing to invest in it can invest in it. So if somebody has made 5,000 crores, it's good for him. If your neighbor invests in this stock and he makes maybe $1,000 out of this stock, that is good for him as well. But in case you don't believe in that stock and you don't invest in that, you should let it be, because this is something that sometimes some stocks, some valuations are beyond our belief, beyond our understanding. Many people would say that the prices in the Sensex and the Nifty today of various stocks, which are even beaten, old stocks, are beyond somebody's imagination. So one can take a call to exit all their money from the markets and put that into a 4% FDR. The other person can continue to be invested. It is a personal choice.
Yeah,
So
because
it is not, I am
valuation
not
at
talking
that
about the
stage
share marketing,
is
sir.
an
I'm
estimate
talking
of
about the
value
valuation.
of
Let me come back to the valuation. So the valuation has to be based on the perspective of the investor, sir.
absolutely.
The duty of the valuer is to look at a item, look at an asset, look at a share, look at a company from the perspective of the possible valuer. That is what IVS also demands out of us. And I think if there is a genuine rate for Zomato stock in 141 rupees, then the valuer who gave it a value at which it got listed, or at which the IPO was done, perhaps is redeemed. Or maybe that valuer is also not redeemed by, and maybe somebody can allege that you valued it lesser than what the market perceived. So you never know
No, but in
how.
case of IPO, you have to be little less than what the market perceives. Only then you will be able to sell it. Even you leave something for the investor on the table.
So not really. There is no duty for the valuer to have a value which is less than the
No.
market's
I mean, it's for the
perceived
promoter
value.
while deciding the
So
price.
today, in case we do a valuation under IBC, sir, say we value a company at 100 crores, and that company finally finds a resolution applicant amongst competition at 200 crores.
Yeah.
The valuer would, I would say that the valuer would say, no, I underestimated the value of this company. But at the same time, it can be the other way around. Maybe some valuer can value a company at 100 crores and the actual market does not find a value at that price. So this is the difference. This is the difference between price and value. And I don't think we can get into that debate that what will be the right valuation and what will happen to the valuer. That valuer did its job and gave a value which the market has validated on the upper side rather than the downward side. That is what we need to understand and move on.
That was right. That was
Any other?
slightly.
Yeah. Any other questions?
Can I ask a question?
Can I continue
Yes,
with
please.
my previous question? But the way you are saying, Ankit, if at all one goes with that kind of approach, then the banker lose the charm of coming to IBC and would rather prefer to go to those kind of platforms where they can fetch higher value. If on the cost, because the banker cannot take any action against the valuer, he cannot even have a grudge against them. And on the contrary, if at all he starts losing the money, so he'll prefer not to come to IBC, and that is the reason the government is also considering, and they are also preferring.
So the bankers, the COC, they would always like to have an environment where a proper market is created for the asset. That is their paramount interest, and we have seen the results in
More realization. More
our own
realization is their
cases.
paramount interest.
We have no more realization. More realization is a result of a proper market creation. In case marketing is done, proper effort is done to make sure that yes, there are all the people who might be interested in an asset are there and bidding for that company. They have all the information that is required by them, that is
Proper
what is
valuation
the
also is required. You see, if the valuation is not proper, then the bidder would not give the higher price. He will go as per the price only.
With permission,
As
may
per
I
the
intervene?
valuation only. Bidder will start with the valuation price, valuation given. I mean, based on that, normally people work. If the valuation itself is less, then I cannot expect any RP cannot expect that bids would come for a higher price.
we have handled auctions where we have had bids, and the final price that we have got for various insolvency related matters have been multiple times of what the valuation report said. And all that has happened historically only because of proper market creation. And we have several examples, Rajiv ji. I would not say that a lower valuation will always result into a lower receipt from the market. The idea is proper marketing, and if proper marketing is done, rather if an asset is available at a lower price than its actual value, maybe the competition has to drive up the price, and there will be so many people idly who are willing to bid for that price, for that asset which is available at a steal, in case the values don't go up. I think we should leave this debate now. We should move on to other questions that other people have.
Can I ask a question?
Yes, go ahead, please.
Yeah, actually, there are two questions. One is, internationally nowadays, the bankers are very interested in knowing how their lending is affecting ESG, and they are taking steps to see to it that their lending policies are aligned with the country's goals. So in India, what has RBI done in this regard? Are there any guidelines or policies for the banks? And my second question is to Dr. Gupta.
Yes, ma'am.
That as a part of IBS, have we started working on some standards for measuring or valuation of ESG assets?
Okay. So I'll answer the second question, because the two papers which have been yet circulated and published as perspective papers by IBSC, this is just the beginning of thinking in this direction, that we should consider ESG factors also in valuation. So straight answer to your question is no. As of now, we don't have any standards, any guidelines, any technical guidance note with regard to valuation based upon ESG, but certainly that's part of our action plan. We have a valuation standards board in ICMAI RBO, and this is part of our agenda. And going forward, within the next few months' time, definitely we are going to come out with some kind of an approach paper. We'll put it up for public debate and public observation and comments, and then probably finalize that. But as of now, we really don't have any kind of a guidance or even a stand.
Thank you, sir.
With respect to your first question, I'm not aware of any policies from RBI with respect to promoting credit in ESG sectors. There are these priority sector norms, but those are basically, those are different. Those are addressed to make sure that certain basic, primary sectors are given focus by banks and not ignored in favor of only industries. So you might say that in some sense has a social impact, but I'm not aware of any environmental or any governance related frameworks. With respect to governance related frameworks, of course, all banks have policies to fund those businesses which are having a good legal framework, a good corporate governance, and so on. And yes, that's one thing that is also analyzed by bankers when they do an appraisal report for a bank finance. And I am also aware of the environmental factors being assessed by, or environmental implications being assessed as part of those appraisals. But I don't think that has practically any implication beyond a write-up. So there is no favoritism for an environmentally, well-fared, environmentally good business as compared to a business which is not having a good environmental implication. But yes, environmental reports and all that are there. But I don't think that impacts the banker's decision.
Dr. Gupta.
Yes, sir.
I don't have a direct question, but I have curiosity to know from you.
Yes, sir.
What is the progress of Indian valuation standards?
So right in the beginning, we had Mr. Rajesh Gupta, Chief General Manager from IBBI, speaking to us. I didn't know at that point of time you were.
No, I did not.
Or not.
I could not.
You could not. So probably he mentioned that as per valuation rules 18, there's supposed to be a committee constituted by Government of India comprising of various representatives for drafting and releasing valuation standards in India. That committee has submitted its report and the report is currently under consideration of Ministry of Corporate Affairs. And
Okay.
what he mentioned, I'm just quoting him, that very soon probably we'll see some of the valuation standards getting released in India as a result of the deliberation with that committee. Yes.
Okay. Is that report available in public?
No, sir. It's not available in public
Okay.
domain as of
Okay.
now. Yeah. Yes.
Okay. So nice of you. Thank you very much. Thank you.
Sir,
Dr. I have a question, Sanjay here. I wanted to check one of the speakers said that India's contribution is hardly 2%. So in terms of that, are we publishing these things on the website and seeking members' views? And I mean, is it getting published somewhere that these are the draft exposure documents that we need to do it, or we are not?
RVO website has all these public documents because we are academic member of the International Valuation Standards Council. I'm not aware about the other RVOs, but ICMAI RVO is definitely putting all these documents on its website and seeking comments from the members and then passing on these observations and our comments to IBSC on a regular basis.
So I, as a member of ICSI RVO, can comment on the ICMA RVO contents?
Absolutely, you can do that, sir. Absolutely.
We can do that. Okay.
Circulate the document to all the members. I mean, we have 4,200 members. Whichever
Okay.
RVO you may belong to, that's a different thing. We all are working in the valuation domain. I mean, there's nothing RVO specific thing kind of thing. So we should all take the benefit of each other's wisdom, each other's knowledge. We will take the lead and we will circulate these draft papers to all the 4,200 odd registered valuers operating in a market. We'll do
Thank
that.
you, sir.
We'll do that.
I'll pick it up from the website, sir. Thank you so much. Thank you.
Hello. Hello.
Yes, Mr. Ranganath.
Sir, just I want to ask a simple question regarding this Zomato to stock valuation, which is widely talked about or widely disputed. So, would like to know what was the comparable company or comparable transaction for this valuation?
So I don't think there was a comparable transaction in India for this share, but then I think it was compared widely with the US equivalent of this idea. I'm forgetting the name of the company, but then that was one comparable that was also used by Mr. Damodaran, Dr. Damodaran, in his analysis of this share. And I think the idea is that it is not only not important that one always has to find a market comparable. Sometimes you have a share or a stock or a company which does not have a comparable presently, but in future any Swiggy or any other delivery based concept comes to market, maybe somebody can use Zomato's price to make a comparable.
But is that justified, sir? Because there are a lot of questions being raised about this valuation or the premium price. I think it has got some justifications.
Mr. Damodaran was of the view that the stock price should have been somewhere in the range of 35 to 40, not more than that. But actually, the company issued the share at 75.
Exactly.
Now it is priced in the stock market at around 140.
Okay, sir. But how the SEBI allowed it, sir? When the valuation report says 30-40 rupees.
No, the valuation report does not say
No.
30-40. Somebody independently
It's
said that
independent
it should
view of
be
the
somebody who is a reputed valuer in the global framework. He has said that 40. The valuer has not said 40. The valuer must have given a value which is based on the listing price only.
Absolutely.
Okay, sir. Thank you.
And whenever you participate in an IPO, you always should see that first line, which is available in all IPO related newsletters, which talks about how many IPOs or how many issues have listed above the listing price from the same merchant bankers. and that's an important information. And it's a high risk job, this IPO job and all that. So yes, many people want to stay safe and invest in more reputed tangible companies. I was interestingly, ITC came out with an outburst where they said, "Why is our price not increasing? What are we doing wrong?" Because they said we are making profits for our investors, but still our prices are not being, our share is not appreciated by the investors. Anyways, it's a long discussion.
Thank
The
you.
stock
Thank you.
market
Thank
is
you, sir.
market is a complicated place.
Thank you.
Hello. Hello.
Hello. Yes,
Yes.
sir.
Hello.
Yes, sir.
Can I speak? My question is to Shri S.K. Gupta, sir.
Yes, sir.
While thanking you, all of you, taking a lot of pain arranging this webinar and educating and the harnessing the, that knowledge and sharing, and the speaker also putting a very nice paper after doing too much research, due diligence, and try to educate the fellow valuers and the IPs. Sir, my request is I want to hear from you. Is there any light after this dark tunnel when any IP, RP, or RB can do a unbiased without influence work in this environment in India? I've seen so many DRT came, then Sarfasi Act came, and IBB came, and CLT, so many things had formed, but still totally all the professionals are work under the pressure, under the influence. They are not allowed to do a practice independently, being crashed by the unseen power in the market. How you can tackle and brought this thing to the knowledge or brought to the surface, how any poor professional can work as a freely unbiased reports, please.
Very good question. Very good question.
As per
And
the
very
code of
relevant
conduct,
and very true.
as per the Code of Conduct, Schedule 1, Valuation Notes 2017, you have various kinds of guidelines where independence of the valuer is being focused quite a lot. You got to
Hello.
be objective. You should not be subjective. You should not work on the
बोलिए।
basis of bias, conflict of interest, anything of that.
प्लीज कोई 10 मिनट बाद करोगे, मैं वेबिनार में हूँ।
Gupta sir.
Ji, sir.
See, I have seen government, RBI, banking, and these all the guideline, Ministry of Finance, IBC are well projected and well drafted and try to implement. But till today, after coming the IBC in the force since last 3 years, or you can say 3.5 years. Take any matter, sir, where anything has been done unbiased, freely environmental, properly independent due diligence regarding from IP, RV or RV, let me tell RG, RP, resolution professional, insolence professionals. And when they immediately they select the person from the market, try to influence him, blackmail him, put a lot of pressure, and force him to do the unethical job under the circumstances.
So true.
That's why this question is arising. Mr. Ankit also very much aware, because they are very, very good and very intelligent faculty. You can say our speaker in our professional. We feel proud also having such a type of people.
Yes, sir. Yes.
And they are putting all the research and due diligence fact from the public platform, but unable really practically when you go for any assignment, for any implementation, any process, lot of unseen, unethical, very drastically pressure come on the professionals, and we became a very poor, helpless. Neither we can do the job, neither we can take the exit.
Ankit ji, you with practical experience of handling so many
So
assignments.
I will share my practical experience, and I will say that in the long run, somebody who is doing good work, compliant work, and somebody who is not merely adjusting his value because somebody has told him to do that, benefits in the industry, gets respect in the industry, and we are witnessing that ourselves. That whenever somebody says that ये value तो ज़्यादा लग रही है, ये value तो कम लग रही है, rather than saying that yes, we don't lock horns with that person, we ask that person for more data. We say that in case you feel that the value is lesser, give me a few maybe numbers, some reference data that I can used to convince myself that the value is lesser or higher, whatever it is. So the idea is to talk about merits of the case, talk about evidence, talk about documentation, talk about a good report, talk about a sound report, so that one, nobody, whether it's at IP, whether it is COC, whether it is the resolution applicant, whether it is the company, maybe the company's workers, nobody goes through a tough time because the valuation report is not appropriate, and also that nobody gets an easy way out or an easy or a low a high value asset for a steal because the valuation report did not address or did not take into consideration a particular aspect of the situation. So thorough research, a good work, and then a good discussion with the COC, telling them that yes, you're well versed with the IVS, you're well versed with the practical scenario in which the company is operating. Your valuation report should offer nobody any chance to raise a complaint, raise an issue. It should talk about the business, talk about the numbers completely. So as long as we are all aiming to do that work and becoming, I would say, aiming to achieve perfection in the field of preparing a good valuation report, we will be relevant in this industry. The moment we become a stamping authority, we will be kicked out like many other professions have been in the history of our country or globally. So we need to be relevant, we need to have our say, and that is what I can say in this regard. It might be practically difficult, but that is what we need to fight out, and in case all of us fight it out, then it's good. In case those people who are making those compromises and who are doing a bad job, in time, I hope that the regulator, the way it has been on the job with respect to insolvency professionals and in disciplinary matters, let's hope that maybe the new or the National Institute of Valuers, whichever regulator comes in, creates a framework for valuers to operate in an independent scenario. The second thing I would say is that I always remember this dialogue from this movie called Page 3. पेज 3 में एक डायलॉग था बिल्कुल एंड में, जिसमें वो कहता था कि सिस्टम से फाइट करो, बट सिस्टम से फाइट सिस्टम के अंदर रह के ही कर सकते हो. सिस्टम से फाइट करने में अगर आप सिस्टम से बाहर निकाल दिए जाओगे तो आप सिस्टम से फाइट कर ही नहीं पाओगे. So please keep that in mind, that keep yourself within the system and fight for your independence, fight for your professional expertise. That is what I can say.
Thank you very much, sir. But my question for all the professional, they can think about how this been still thing has been picked up, selected from the market and very much available, including me. But anyhow, thank you very much. Thank you, sir. Thank you.
Thank you. Thank you.
Thank you all so much for participating in this very lively, interactive valuation standards conclave organized by ICMAI Registered Valuers Organization. I thank Mr. Alexander, who was the special guest from IVSC, Technical Director, Intangible Assets. I also thank Shri Rajesh Kumar Gupta, Chief General Manager, IBBI, who was the chief guest of the program today. I also thank CMA Rakesh Singh Ji, who is the chairperson of ICSI Registered Valuers Organization and also chairman of Valuation Standards Board of ICMAI RVO, and the two very knowledgeable learned speakers, Madam Padma Ganesh, Registered Valuer, and CA Registered Valuer, Mr. Ankit Goel, for providing a very knowledgeable inputs and deliberations in this particular valuation standards conclave. I look forward to all of you joining us regularly on the professional development programs being conducted by ICMAI RVO. We conduct programs 4 days a week, Wednesday, Thursday, Saturday, Sunday. 4 days a week, we are conducting regular professional development programs. Many of you would have already participated, and we look forward to your participating in future programs also. Thank you so very much for joining us all. Thank you so very much. Good evening. Namaskar.
I have a small query, Dr. Gupta ji,
Ji, sir.
regarding Valuer Act, because that will solve so many problems.
I know, but there's no news as of now, sir. Valuation Bill 2020, we don't know when it is really going to come out and what kind of provisions it will contain. There's no news on that front as of now.
Okay, let us continue making efforts for that?
No, we really don't know what actual framework is going to be there within that. So unless something concrete comes from the government side, I mean, there's no point looking at that in a draft form. Because,
Okay, okay.
yes.
Right now we have 1st October as IBBI Foundation Day. I think this can also be raised there.
Yeah, probably we can do that. 1st of October.
Thanks a lot. Thanks a lot.
1st of October, yes, sir. Thank you
Yes,
so
and
much.
regarding that last person who asked a question about the system trying to crush the valuers and
Yeah.
things like that, that is where your valuation standards come into play. Na? You just have to follow the standards, and whoever is trying to, crush you, you can tell them, you seek justification, you abide by your standards, you can show them the standards and tell them that you cannot work beyond this framework. You have to work within that framework. So I think that should take care of the situation, because no client is so arrogant as to not understand what you are trying to put forth. You can put to him in a nice way. You can tell him that you are governed by these, and you need these kind of justifications. So I think that should take care of it.
Still,
So that
Yes,
madam,
madam.
there are
Yes, yes, madam.
examples in every profession. We have some people who get awayed by the professionals.
No, that let it be their
cannot
part.
avoid
But,
that.
no,
Yeah,
let it be their portion. But let us stick to our principles, because that will take care of our, that is for our safety. As I said, you should be able to defend your valuation.
See,
That
ma'am.
should be your motto. That's it.
Yeah, yes, ma'am. Happy to hear from you. But this is the reason why the valuer bill and the standard is gone to cold store. Let me tell you, it would have not taken us so much time, decade to come in the picture. Still, it is not coming. This shows there is some vested interest, some unseen force behind of that to get hold and put them this back door or store or in cold storage. The things start moving. After that, it gets stuck up somewhere else. Since last 15-20 years, we are seeing same things.
I think we have quite different sort of professionals. Everybody cannot be like Ankit Goel or Madam Padma.
Yes.
So the level of knowledge varies from 10% to 100%. So that is the question. Unless that we can develop, as Dr. Gupta also said, we will keep on developing, updating, and those who do not get updated, they will be outdated. Simple.
Absolutely.
So Mahesh ji, we are all students of valuation and we'll keep learning. As
Yeah, we
Gupta
all
ji
keep
said,
learning
he has
every day.
four sessions every week. So that is where we will keep learning, keep enhancing
Yeah.
our knowledge.
Absolutely.
And
Yes, this
thanks.
profession is completely about updating and upgrading yourself on a daily basis. Every day you face some new situation, new problem, and you have to find ways out.
Every case
Not
is a
everything
learning
is
case,
available
learning
in the
case.
books. You have to relate so many things and arrive at some conclusion. So
Yeah.
it's a continuous process.
Thank
That
you,
is
Gupta
where
ji.
the standard 102 will come in a bigger platform. Standard 102 will take care of all these things.
I know 102 will take care of all. Thanks.
Very
Mr.
good,
Gupta,
sir.
thank you very much.
sir.
Thank you
Thank
very
you, all
much
of
for
you.
organizing this
Thank you.
wonderful conclave, sir.
Thank
It was
you
a
so much.
wonderful
Thanks for
experience.
joining.
Very
Great
good.
learning
Very
experience.
Thank you, everyone. Thank you, everyone.
Thank
Had
you
a
all.
great learning experience.
God bless
Thank
all
you.
of you. God bless.
Thank you, everyone.